Hi, everyone. Welcome back to Old Men, New Money. I'm your host, and today we need to talk about something that happened 2 months ago that should have stopped every trader on Wall Street in their tracks, but somehow it didn't. September 3rd, 2025, Galaxy Digital tokenized their NASDAQ-listed shares on a blockchain. This was huge. The first SEC-registered public equity tokenized directly on a major blockchain. Real shares, full shareholder rights, 24/7 trading potential. But here's the kicker. They didn't use Ethereum, they used Solana. Now, if you're listening to this and thinking, who cares? What's the difference? Well, buckle up, because traditional finance is about to learn a very expensive lesson about betting on brand names instead of actual performance. So let's set the scene here. When Wall Street thinks blockchain, they think Ethereum. BlackRock, launching funds on Ethereum. Franklin Templeton, tokenizing on Ethereum. JP Morgan built their entire Onyx platform on Ethereum. It's the household name, the trusted brand, the one that compliance departments approve without blinking. And I get it. I really do. Back when I was part of the INX team, we were the first SEC-registered security token offering. And we chose Ethereum too, because back then regulatory comfort mattered more than performance. But here's what I need you to understand. That was then, this is now. Galaxy Digital had every reason to play it safe and choose Ethereum, but they didn't. They looked at the actual data, the actual performance requirements, and they made a different call. And that decision tells us everything we need to know about where this market is actually heading. Because right now, TradFi is making what I genuinely believe is a $1 trillion infrastructure mistake. They're choosing the blockchain that feels familiar over the blockchain that actually works at the scale modern finance requires. All right, let me give you some numbers that should absolutely terrify anyone who's all in on Ethereum. Solana is 5 years old now, launched in March of 2020. So let's compare apples to apples. Where was Ethereum at 5 years old? Back in 2020, 5 years after Ethereum launched, the network was processing about 1.1 million transactions daily, about 500,000 active addresses. Those were respectable numbers for a pioneering blockchain. DeFi summer was just getting started. Now look at Solana today, also at 5 years old. In the third quarter of 2025, Solana averaged 93.5 million daily transactions. That's not a typo. 93.5 million. That's 85 times more than Ethereum at the same age. Now, yes, those numbers have cooled off as meme coin mania has calmed down. We're down to around 64 million daily transactions in early October. But here's the thing. Even at 64 million, Solana is still processing 40 times more transactions than Ethereum did at 5 years old. And more importantly, it's processing 40 times more than Ethereum does today, right now, today. Active addresses, Solana hit 22.44 million. That's 45 times more than Ethereum's 5-year mark. But you know what really gets me? It's not just the transaction numbers, it's where the developers are going. For the first time since 2016, a blockchain ecosystem attracted more new developers than Ethereum. In 2024, Solana onboarded 7,625 new developers, compared to Ethereum's 6,456. That's an 83% year-over-year growth rate. And this isn't me making this up. Electric Capital analyzed 902 million code commits across nearly 2 million repositories. The data is crystal clear. The talent is moving to where the performance is. And this momentum continued into 2025. Solana now averages 2,500 to 3,000 monthly active developers. India, which is the world's second largest developer market, is the only country where new developers join Solana at a higher rate than any other blockchain. And these aren't vanity metrics, folks. This is the future voting with their keyboards. So let's talk about why this performance gap matters, because I think this is where TradFi is really missing the boat. Most traditional finance executives, they know Ethereum is established and secure, but they haven't grasped why those attributes matter less than they think for certain use cases. Here are the actual numbers. Ethereum processes 15 to 30 transactions per second. During network congestion, fees spike to $20, $50, sometimes over $100. Transaction finality takes 12 to 15 minutes. Average fees are about $1.85 this year. But complex, smart contract interactions during peak times can exceed $95. Solana processes thousands of transactions per second. Real-world performance is around 900 transactions per second. Stress tests have hit 100,000 transactions per second. Transaction fees are a quarter of a cent, $0.00025. That's over 10,000 times cheaper than Ethereum. And finality? Currently 12.8 seconds, but with the Alpenglow upgrade rolling out in the fourth quarter, that drops to 150 milliseconds. Let me put that in perspective. 150 milliseconds is faster than a Google search. It's faster than Visa card processing. It's fast enough that users can't even perceive a delay. Now, here's the framework that I think Wall Street is completely missing. Success isn't about which blockchain is better in absolute terms. It's about which blockchain is actually better than what it's replacing. Think about private equity. Lawyers, paperwork, waiting periods, massive friction, no secondary market, maybe 50 to 200 sophisticated investors transacting a few times per year. Ethereum crushes this use case. A $20 gas fee and a 50,000 equity transaction, that's nothing. The compliance tools exist, the legal frameworks exist, institutional familiarity exists. Literally anything beats the current off-chain process. But now think about public equities. NASDAQ gives you sub-second execution, minimal fees, instant confirmation during market hours, thousands or millions of shareholders trading frequently, high-frequency trading firms executing thousands of transactions per second, market makers updating prices in real time. This is where Ethereum fails. The bar for improvement is dramatically higher. Blockchain needs comparable speed, lower costs, massive transaction capacity. Paying $20 in gas and waiting 15 minutes for finality doesn't compete with TradFi. It's objectively worse. Solana clears that bar. Ethereum can't. That's the whole game. Let me give you another angle that makes this even clearer. Let's talk about stablecoins. Yes, Ethereum hosts $172 billion in stablecoins, compared to Solana's $13.9 billion. TradFi looks at these numbers and thinks Ethereum is winning, but they're measuring the wrong thing entirely. Each stablecoin dollar in Solana drives 8 times more DeFi volume than Ethereum. 8 times. That's not a typo. Why? Because when transactions cost pennies, people actually use the stablecoins. When transactions cost $20 to $50, people just hold them. And check this out. Solana captured 43% of all global DEX volume in the first half of 2025 and processed 81% of all blockchain DEX transactions, more than double its nearest competitor. Third quarter volume hit $326 billion, with recent daily peaks exceeding $8 billion. Jupiter, which is Solana's leading DEX aggregator, processes over 50% of all DEX aggregator volumes across all blockchains. Not just on Solana, across every chain. Let that sink in for a second. Meanwhile, 4.4 million people use Solana for stablecoin transactions every single day. These aren't crypto degens. These are real users sending real money because it actually works. Now, I know the Ethereum maximalists are going to say, but wait, what about layer 2 solutions? Fees are lower on layer 2s, and yes, that's true. But here's what they're not telling you. You've now fragmented liquidity across dozens of rollups. Arbitrum, Optimism, Base, ZK Sync, Polygon, Scroll, Linea, the list keeps growing. Each one has its own bridge risk. Each one fragments the user experience. Each one requires developers to choose which layer 2 to build on, which means choosing which slice of liquidity to access. Solana just works. One network, unified liquidity, instant confirmation, no bridges, no fragmentation, no choosing between layer 2s, and hoping you pick the one with enough users. The market is speaking. The question is, are you listening? Now, I know what some of you are thinking, but Solana, don't they sacrifice security for speed? Well, I think this narrative needs to die. Look, Solana had growing pains. Network outages in 2021 and 2022 were real. But those issues forced the network to harden its infrastructure. The result? A battle-tested system that now processes billions of dollars in daily volume and millions of transactions without breaking a sweat. The network has a Nakamoto coefficient of 20. That's one of the most robust measures of decentralization in the industry. And when they proposed the Alpenglow upgrade, 98.27% of validators approved it. That's decentralized governance actually working at scale. Now here's what really matters. Users trust it with their money. In the second quarter of 2025, Solana generated over $271 million in network revenue. That's its third consecutive quarter leading all blockchains. That's not speculation. That's fees paid by real users for real transactions. Compare that to Ethereum's situation. Despite successful upgrades, Ethereum's mainnet activity has hit its lowest level since July of 2020. Transaction counts are down. ETH ETF flows are negative. The ETH to BTC ratio is at multi-year lows. The market's telling you something. Are you paying attention? So here's what's happening right now that traditional finance is sleeping through. Regulatory precedent is equalizing. With Galaxy's approval, Solana now has SEC precedent for tokenized public equities. The regulatory moat that was protecting Ethereum, it just fell. Spot ETF approval is basically certain. Polymarket and Bloomberg analysts put the odds at 99 to 100%, with decisions expected any day now. When that happens, institutional access to Solana becomes as easy as buying any other ETF. The floodgates open. Institutional infrastructure is building. The same custody providers, transfer agents, and compliance tools that made Ethereum comfortable for institutions are now available for Solana. If I'm right about this, and the data overwhelmingly suggests I am, we're about to witness a massive platform migration in financial markets. Within 24 months, here's what I think happens. Stablecoin dominance shifts to Solana as issuers and users prioritize efficiency. New asset tokenization launches on Solana for securities and digital assets. Developer talent completes its migration to the platform that actually works. Consumer apps become Solana native because users demand better user experience. And business models requiring high frequency, low-cost transactions finally become viable. Ethereum is dial-up. Solana is fiber optic. And once you experience instant confirmations, negligible fees, and 24/7 availability, you don't go back to waiting 15 minutes and paying $20. Look, here's my fundamental concern. Traditional finance is making blockchain decisions based on brand recognition, not technical capability. They're choosing Ethereum because it's the name they know, not because it's the platform that serves their actual needs. This worked when blockchain was experimental, but we're past that phase now. We're talking about major public companies tokenizing equity. Millions of retail investors trading these assets. Stablecoins becoming the primary medium for everyday commerce. The performance requirements just changed fundamentally. The math is simple. Private equity on Ethereum beats private equity off-chain. That's a low bar. Public equity on Ethereum loses to public equity on traditional exchanges. That's a high bar. Ethereum can't clear it. Public equity on Solana competes with and exceeds traditional exchange performance. Solana clears it, and that's the difference. Traditional finance loves Ethereum. It's the brand they know. But familiarity is a terrible reason to make a $1 trillion infrastructure bet. The data doesn't lie. Solana processes 81% of all blockchain DEX transactions. 4.4 million people use Solana daily for stablecoin transactions, paying fractions of a cent. The network generated $271 million in the second quarter of 2025, leading all blockchains for 3 straight quarters. Galaxy Digital got it. They evaluated performance, not brand recognition. They chose Solana for public equity tokenization. They chose correctly. The rest of traditional finance needs to wake up. When all assets go on-chain, and they will, the winners will be the institutions that recognize which platform is built for scale, speed, and mass adoption. The developers know it. The users know it. The data proves it. TradFi doesn't know it yet, but they will. Well, that's it for today's episode of Old Men, New Money. If you find this valuable, please share it with someone in traditional finance who still thinks Ethereum is the only game in town. They need to see these numbers. You can find me on X at DC Borthwick. And if you want to dive deeper into the topic, I've got the full article with all the data points on our Substack at oldmennewmoney.com. Thanks for listening, and I'll catch you on the next one. Stay curious, stay skeptical, and follow the data.